Yes, that's fine, Mark. Thank you very much for that. I'm going to provide you with Drewry's analysis and outlook for the container equipment market and the leasing segment in particular. And so the starting point then for that will be to firstly look at the background to what's been happening in the container shipping market. That'll be very brief because I know you had a lot on that yesterday. I'll then move on to look at the development of production, the fleet, and also the ownership, and obviously the lessor share of that. Before I then move on to look at the container equipment availability issue, particularly in the context of what it's meant then for container equipment prices and lessor per diem rates and cash returns. And I'll then finish off with some conclusions. So starting point is really just to look at the container shipping market. And this chart here is tracking the development of global port throughput, which is shown by the dark blue bars, and the brown line, which is tracking the year-on-year percentage change in that throughput. And as we all know, last year saw a contraction in trade, but a very mild contraction. We estimate it was little more than 1%, and particularly mild given that we had a contraction of 3.6% in global GDP over that period. And the reason why the container trade ended up performing much better than expected, given that GDP contraction, was that we saw this big shift in spending from services to consumer durables, as many people in Western societies were locked up and unable to go out and spend money on services, so they spent it on durable goods for their homes and gardens. Also, we saw a major restocking of inventory by retailers and manufacturers following the contraction in that through the first half of last year, as they sought then to rebuild those inventory levels. And that's continuing today. And that's been fueled by an e-commerce boom and government stimulus packages. So we're therefore projecting then that for this year, we will see global port handling expand by as much as 10%. This will be the fastest pace of recovery since 2010, when the industry was recovering from a contraction of 8.5% in 2009. So the acceleration we saw in trade back in 2010 was on the back of a very sharp reduction the previous year, therefore expected. This year's acceleration in trade is therefore particularly significant given the much smaller contraction in the previous year. And the effect, as we all know, of this very resurgent rebound in cargo demand and the supply chain disruption that we'll come on to a bit later, has been record high freight rates and carrier profits. And the effect of that has been for carriers to invest more and more in their shipping fleet. So by the end of July, the order book for new vessels had reached, for 2021 alone, 3.5 million TEU. So this already exceeded the previous year's record of 3.3 million TEU back in 2007. So that's a full year of 2007. So already we've exceeded that. And the total order book is over 5 million TEU. That's cumulatively, including previous years. This is the highest it's ever been since 2008, before the great crash of 2009. And therefore, we're going to see quite an acceleration in the fleet, which we'll see by 2023. We expect that year the fleet to expand by as much as 7%. And whilst it will slow a bit there afterwards, we're still going to see accelerating fleet. So therefore, the combination of this very fast growing cargo demand and accelerating fleet means that there will be increasing demand for shipping containers, both owned and leased. Okay, so what does this then mean in terms of production, fleet, and the ownership share? Let's look on to that. So this chart is then showing you the development of the production of shipping containers, and the brown line is then tracking the quarterly development of the shipping container output. So we can see, looking at the chart, that in the second half of last year, there was quite a sharp recovery. In fact, production output was 77% up over that period on a year earlier. And that production increase has continued now into 2021. So in the first half of the year, we estimate that 3.4 million TEU was delivered into the market, and this is higher than the total production output recorded for the whole of 2019 and the whole of 2020. Quite extraordinary increase there. Now, the big drivers then behind this is obviously this rise in cargo demand that we've referred to, but also not just for dry produce, but also for reefer perishables, and also cargo moving in tank containers, which is driving production for both reefers and tank containers, as well as these dry cargo containers. The other reason, as we know, is that not only have we got rising cargo demand, but we've also got this continuing disruption across the container shipping supply chain, which means that it's taking much longer for containers to complete their voyages. And the same thing is happening, obviously, with ships, and therefore we're seeing inefficiency in the equipment fleet, and mirrored with the container vessel fleet as well. The other factor that's driving production at the moment is a need to replace a bulge of equipment built in the mid to late 2000s, which is intensifying despite owners' attempts to extend the life of existing equipment. The other factor, looking at the reefer new builds in particular, is that companies have been bringing orders forward ahead of impending temporary factory closures as manufacturers change their paint spray systems. That's bulged orders and production in the first half of the year. So continuing then on the theme of production, but really looking at what this means for the fleet. Here we're tracking the global fleet. This is shown by the blue bars, and you can see then that the smaller bars, the brown bar is showing total production in the year, and the blue bar is showing the replacement part of total production. In other words, that amount of production which is earmarked for replacement. And then the brown line is tracking the percentage of production earmarked for replacement. And of course, the shaded area is our estimate of what will happen going forward. So in 2020, we estimate, by the end of 2020 rather, we estimate the fleet reached 44 million TEU, which is an increase of around 4% on the previous year. Now, we know this because we conduct a survey of equipment owners every year, so we have a very accurate reflection of the overall fleet at the end of each year, and also how that is structured, both in terms of equipment type and also by ownership. We expect the fleet to grow at an average annual rate of around 4% over the next few years, so pretty much following the growth that we saw in the previous year. As mentioned, and as you can see, replacement is becoming a much bigger reason for owners to order equipment for the reasons that I gave you a bit earlier. And in terms of the fleet development, we expect to see the reefer fleets and tank fleets expand at a faster pace than the overall fleet. And in fact, the tank fleet will expand, we think, at an average annual rate of around 6% a year over the next few years. Now, driving the expansion in fleet and tank fleets is not just buoyant cargo demand, but also we're seeing this modal shift. So we're seeing reefer containers and tank containers take a larger share of the addressable market for the commodities moving in those containers. So in terms of production output, we expect that to exceed about 3.5 million TEU a year for the period up to 2025. And this will be despite little anticipated change in overall capacity. We know that the Chinese manufacturers increased capacity by around between 12 and 15% over the period since the late summer of last year, but we're not anticipating much additional capacity coming into the market. What we are seeing, though, is initiatives to increase production of containers outside of China. And many of you may know that a plant is due to open in Vietnam next year with a capacity of 200,000 TEU a year. And there are other initiatives underway as well. So in terms of how the fleet is shared between lessors and transport operators, and the latter is predominantly made up of container shipping lines, this chart shows that. So the blue bars represents that part of the fleet controlled by leasing companies or lessors, And the brown bars shows that part of the fleet controlled by transport operators. And the brown line is then tracking the lessor share of the fleet. So as you can see, the ownership is split pretty equally between the two key owner groups. The lessors, though, have been increasing their share of the fleet over the last decade, and by the end of 2020, we estimate that share had reached 52% of the overall fleet. So they controlled the majority of the fleet. And in fact, so far this year, we've seen lessors buying the majority of new containers. In fact, in the second quarter, they purchased around 65% of the total output. However, if you look at the chart, you can see that we project that lessors' share will decline over the next 2 years. It will decline to below this 50% threshold for the first time since 2015. Now, why is this? The principal reason is that lessors' share rose over the last decade because carriers were very short of cash following many years of very poor profitability. They would therefore turn to lessors to effectively finance their acquisition of new containers to bolster their fleets and replace aging containers. However, as we know, carriers are now making a lot of money. They have a lot of spare cash, and therefore we expect some of that cash to be used for them to increase the proportion of new containers that they buy under their own rights. And therefore, the lessor share of the fleet will fall over the next couple of years below 50%. But we think that actually towards the end of this forecast period, their share will rise a bit as the market starts to normalize, carrier profitability declines, not back to the pre-pandemic levels. We think they have reasonably good prospects, but nonetheless to a degree that will then bring them back to taking more containers from lessors. And therefore, we expect by the end of the forecast period that the lessor share will be around just over 50%. If you're wondering who all these lessors are, they're listed on the screen in front of you here, or at least the top 10 are. And the blue bars shows you our estimate of their total fleet at the end of last year. This is based on a survey of all the owners, so it's pretty accurate. And also the percentage values there represents their percentage share of the leased fleet. Now, the interesting thing about the container leasing market is that it's incredibly concentrated. So the top 5 lessors control 80% of the leased fleet, and the top 10 control as much as 95% of the fleet. Now, in 2020 saw very little M&A activity, but we have seen quite a bit since, and this is therefore leading to further concentration in the fleet, particularly where we're seeing existing owners of leased assets buying into other leased companies, and therefore we're going to see some consolidation. And we expect this to be a trend going forward as economies of scale become increasingly important to drive down costs and maintain strong returns. Looking now to container equipment availability, which is a very hot topic at the moment for many of you, I'm sure, but it also has implications then for the prices of containers and the per diem rates charged by lessors. This chart here is tracking the development of the maritime or ocean-borne container shipping fleet. So this represents that part of the total fleet which is used by the container carriers for ocean-borne transport. The remainder is land-based, and we're tracking that here against the port throughput ratio. So this is a measure of total port throughput relative to the total fleet, and you therefore from that you get a factor or ratio which is predominantly usually been around 20. And at the moment, we reckon that ratio is slightly below 20, as you can see from the chart, which is therefore below the average that we've seen over the last few years, but we do expect it to increase a bit. So therefore, by this and a number of other operating ratio measures, the fleet is not unusually small relative to the development of cargo demand. And therefore, the size of the fleet or the alleged underinvestment in the fleet cannot be used as a reason to explain why we're so short of containers. But we appear to be, and of course, a lot of that was because of the effect of blank sailings through the early part of last year that disrupted the recycling of empty containers, remembering that many of the trade lanes are heavily imbalanced, and therefore carriers have to recycle empty containers back from the main consuming markets to origin points to take cargo. Of course, that process of blank sailings then meant that when cargo demand returned, many containers were in the wrong place. And that situation has been exacerbated by increasing port congestion, particularly across Europe and North America, and then the grounding of a ship in the Suez Canal for a week also disrupted the trade, as has temporary closures of terminals in China in particular due to COVID containment measures. And also all along, we've also had shortages of labour and key parts of the supply chain, either the result of public health containment measures for the containment of COVID-19, or simply underlying shortage of workers in key areas such as trucking to move containers to and from ports. So whilst the container equipment availability has clearly dominated discussion and concerns, it is not really driven by the overall size of the fleet necessarily. It's really been because the fleet has become incredibly inefficient because so much of it is snarled up in congested ports and other parts of the supply chain. So we estimate that if you look at the fleet and the typical cycle time of a container across the fleet, across the global fleet, we estimate that it's increased from an average of 67 days pre-pandemic to around 72 days today. So that's an increase of 5 days. Of course, this is an average across all trades. We know that on certain particularly high volume and heavily imbalanced trades, the change in this factor has been much greater. And trades are heavily imbalanced. This is a key feature of the container shipping market, and it makes therefore the return back to some kind of equilibrium even more challenging. So here we're looking at imbalances for reefer containers. The interesting thing here is that Asia has a net surplus of containers, because it is a net importer of perishables from the rest of the world. But the main producing centers of perishables, that's Latin America, Southern Africa, and Oceania, as you can see, have major deficits of reefer containers. Of course, if you look at dry containers, you'll see a bit of the reverse, because obviously Asia is the main export workshop of the world, and therefore has a big deficit of dry freight containers, whereas many of the other consuming markets have the opposite situation. Okay, so what has all this meant for new build prices and lessor cash returns? So firstly, looking at new build prices, and here we're tracking dry freight new build prices on a quarterly basis, and you can see that from the fourth quarter, new build prices started to rise very sharply, really mirroring what we've seen in cargo demand development. And by the second quarter, average 40-foot high cube prices had reached an average of around $6,500. So whilst the pace of increase had slowed by that time, that still represented over the course of a year a doubling of price levels. But actually, more significantly, this is by far the highest price level we've seen in living memory. In fact, it's the highest price level that Drewry has recorded since it first started recording container prices back as far as 1998. So that just shows you how high prices are today. Now, the price levels are high not just because of all the issues we just explained about the demand for equipment and the tightness in the market. There's also been some other drivers at play too. Input costs have gone up. So cotton, steel, and flooring materials have increased in price. And steel prices, we think, will stay high over the next few years. So that's not going to change a great deal. Labor costs have risen as well. And also, to some extent, manufacturers have leveraged the current situation to improve their profit margins particularly following several years of very low profitability or even losses. So obviously, so big parallels to some extent with what we've seen with the container shipping lines. Looking ahead then, we think that dry freight prices are probably peaking at the moment, and therefore over the next couple of years, we're going to see prices moderate. We don't think there'll be a significant fall in prices because manufacturers, we expect to manage capacity in a way to limit the potential fall in prices, but they will fall, although quite moderately, but not back to pre-pandemic very low levels. If we now turn to reefer and tank prices, here we can see that the development of prices here has been much more moderate. So reefer prices have really changed very little. Tank prices, we saw quite a sharp spike in the second quarter, where year on year, the increase was as much as a third. And driving this has been the big rise in stainless steel prices, which is a key constituent in tank containers particularly, but also in reefer containers to some extent. And this is really because nickel, which is a key constituent in stainless steel, has increased in price quite notably. But also, as has prices for accessories and components needed to manufacture tank containers, and also insulation used in reefer containers. We think reefer container prices have a bit further to go, partly because the effect of the change in this paint systems for the manufacturing of reefers is going to add to costs, and we think that'll feed into the box price. But half the cost of a reefer container is taken up by the machinery, and those prices have remained pretty stable. In fact, they've come down to some extent over recent years, and we don't expect any major changes in those prices for the cost of the machinery over the next couple of years. And then in terms of what this means for per diem rates and cash returns, so here we are showing you a chart of per diem rates shown by the blue and grey bars. These are for containers on long-term lease, so most of the leased fleet is now on long-term leases, so relatively few are on master lease agreements. And then the lines here are tracking the initial cash returns. This is the returns on the original new build prices. So if you're looking here then at the dry freight per diem rates, these have increased quite markedly, doubling in the year to the second quarter, so mirroring to some extent the development of dry freight container prices, and have reached the highest level since 2011. Reefer per diem rates, which are not shown in this chart, have risen much more sedately, around 11% in the year to the second quarter, to reach the highest level since 2018, so a more recent relationship there. And tank per diem rates, we estimate, rose in the second quarter by 28% over the year, so just slightly shy of what we saw in new build price development. So we expect per diem rates to continue rising a bit through this year, but will soften thereafter with falling new build prices, and for reefer and tank per diem rates to remain more stable. The cash returns, you can see, have improved as lease rates have then, per diem rates have caught up with the rise in new build prices, and we expect these to improve a bit further through the course of the year. But over the next couple of years, we expect them to come under some pressure as the carriers place more emphasis on buying their own containers. This will lead to a slight reduction in the utilization of the leased fleet, which will be reflected in initial cash returns. Okay, so let me just finish up with a few concluding points. So we're seeing today a big recovery in the container shipping trade, and together with ongoing shortages and disruption in the container supply chain, is leading to very strong demand for new shipping containers. We think this disruption across the container shipping supply chain will continue for some time, well into next year, we think, but we believe it is temporary. It's not driven by the size of the fleet necessarily. It's really to do with this disruption, and therefore we expect it to abate. We expect carriers to increase their investment in their own fleet, which will see lessors share the fleet fall below 50%, temporarily at least, over the next couple of years. We think dry freight container prices have peaked and will fall off over the next couple of years, and lesser cash returns have been catching up with new build prices and will continue to do so through the year, but we then expect them to soften for the reasons that I've just given. Okay, thank you very much for your time, and I'm happy to take any questions, Mark, that we may have time for.
Good. Thank you, Martin. Can I just immediately jump in before we do questions and say that in my slightly chaotic start to the session, that I did not mention that this keynote is sponsored by the DCS silver sponsor Portcast. They have a very interesting website for those who are looking at tracking of cargoes around the world. Anyway, so that's an important thing to mention. Martin, I have a couple of observations and questions for you. It's interesting to see shipping lines. My personal view is that the container shortage is partly all the short-term issues that you mentioned, like boxes getting stuck in the wrong place for all the reasons we saw, and of course this surge in type of cargoes that are being moved, and so it's quite difficult to really form a strong argument that those will still be factors 2 to 3 years from now, and therefore the carriers actually investing in large increases in tonnage is like, okay, fine. Is this because there is going to be strong growth in cargo over the next 5 years? Putting aside the short-term issues. And of course, one of the things that has been talked about a lot, and I know it's not really the topic of this particular forum, of course, is that the port capacity has been shown to be lacking in a lot of locations too. So I'm here wondering whether in 3 or 4 years' time we'll see freight rates under pressure again, because there's been too much capacity brought in, which may not really have legs for long-term cargo growth. But so you may have opinions on that, Martin, but we obviously know these are things that are difficult to predict so many years out.
Well, I think I'd agree with you, Mark, actually. So I think that the obviously a large chunk of the growth in the projected fleet and the order book that's happening at the moment is being driven by the need to replenish aging tonnage, and also to reflect the growth in cargo demand. And the projections at the moment show that growth is faster than the trend that we saw pre-pandemic, and therefore that explains some of it. But obviously there is a concern, though, that there may be over ordering, and also that therefore will lead to, once the market normalizes and the constraints, capacity constraints, and the disruption that we're witnessing today winds out, then we would be back to some pre-pandemic situation of latent overcapacity potentially. And yes, we'd expect then rates to fall. That will affect the profitability of the carriers and will be reflected then on their ability to continue to purchase their own container equipment, and therefore the role of lessors increasing their activity in that regard too. So I think I'd probably agree with the synopsis that you've just described.
Yeah. Well, as I say, we all know from many years in this business how difficult it is to really predict too far ahead. But that certainly would be a gut reaction, I think, to what we've seen here. I think your observations, obviously, on the price trend of containers, I think that they're very valid comments in the sense that yes, there are a lot of fundamentals that have pushed the container price up, and certainly whilst China is still dominating container manufacturing, which it does today, you mentioned obviously Vietnam coming up. I think these new factories may start to provide a different competitive landscape, should we say. Obviously, time will tell. And so I think you're right that prices are not going to collapse back to 2,200 or roughly whatever the long-term average is for a 20-foot price. We will see those perhaps soften a little bit as the peak goes. It will be difficult for anybody to maintain those. But I think we should probably expect to see them certainly above $3,000 for at least the foreseeable future. As I say, there are lots of factors there. We'll have to see how that plays out. You mentioned, of course, the cash on cash returns of leasing companies. I think just to add to what you've said there, leasing companies use leverage capital, so debt. The rate of interest rates on debt is very important driving factor in the cash and cash returns required. And so with incredibly low interest rates, really for the last 10 years, but certainly again more recently because of the pandemic, we've seen the ability for leasing companies to get debt levels down at very low interest rates. This obviously enables the cash-on-cash returns to be profitable, even if they're relatively low. Having said all of that, of course, we've had this rise in prices, which may not be maintained, say, 10 years or 15 years' time when boxes start to get sold. And so residual values, there's an uncertainty over what the residual values will be 10 to 15 years out when leasing companies have to sell those boxes. And for that reason, of course, if you are modeling that, as you should before you buy the containers, you need to make sure that your initial lease rates are enough to cover a potential downside in the residual value, which is obviously quite a significant portion of the value of a container, as we know. And boxes are roughly 20 foot, roughly half the price of a new container when they're disposed of at the end of life. Maybe 40 high cubes is a little bit lower than that, but that's obviously something that I think has been a factor in this. But so the cash and cash returns haven't risen as much as we expected because of this important factor. But that's really because leasing companies have been able to get 10, 12, even 13, 14-year leases. So effectively importantly, mitigating that downside risk. And I think whilst some people will say, well, that's not fair. If you want people to invest in a rapidly rising priced asset in a time of uncertainty like a pandemic, then you've got to expect to have to commit to a longer period of lease. And I think it's probably something that will be a rounding error in the long term, but certainly in the short term, it's been a notable feature. But something that has enabled leasing companies to invest.
In the first half of this year, it's certainly been very notable, Mark, isn't it, in terms of the number of lease agreements that have seen these extended lease periods longer than we've seen previously.
Yes, indeed. Yeah, no, indeed. Anyway, so time will tell again what happens on that. We have a question, or at least a comment from François Duplessis in the audience, I think, who's saying, there's a question regarding container pricing, how quickly it will fall. Prices seem to be high due to short-term problems. Therefore, surely, as soon as the logistics challenges are resolved, a very quick flow back into the system will occur and prices will drop on used containers quite quickly. What are your views on this, Martin?
Well, we do think that the price of containers will fall, both new and used containers. I think the speed at which that happens is very difficult to predict. But from what we've seen so far, this process will take longer than many people think because of the ongoing disruption in the trade. And as you rightly point out earlier, Mark, the issue, not only is it to do with the positioning of containers and where they are, but also this issue of port congestion and whether the ports have sufficient capacity to cope with the rising cargo demand. And Drury's recent research and projections suggests that port capacity will not keep pace with the rising cargo demand, and therefore that could be a lingering issue in terms of container cycle times and the disruption. But notwithstanding that, though, we would expect to see a decline in new build and used prices over the next couple of years.
Yeah, and just to add to that, I agree with you, what you said there, Martin. I think just to add to that, of course, one of the functions of used container prices is the utilization of the global fleet. Now, whether that's leasing company utilization or shipping line utilization doesn't really matter, because obviously they're connected. And I think that certainly what we may see as those trapped inventories or the inefficient use of containers starts to become more efficient in the next, say, 12 to 18 months, is that we will see utilization levels slip for leasing companies and for shipping lines, enabling them to start selling more containers. And therefore, we may see a significant change in the supply of older containers coming back into the market. And that obviously might depress the used prices at that time, even if the new container prices are maintained quite high. I mean, they are fairly close correlation between new container prices and sale prices. But of course, supply is another critical factor, and that may obviously be significantly altered once we see utilization levels slip in the next, say, 12 to 18 months.
Yes. Yeah.
Any other questions from the audience? I can't see any more. So, Martin, thank you for, as usual, a very informative and interesting presentation. I hope the audience have enjoyed today. Again, thank you to the sponsor of this session, Portcast. which has been enabled it to be a success. So if that's everything from the floor, I'll declare this session closed. Thank you again, Martin.
Thanks, Mark. Thank you, everybody. Bye-bye.